Hi, I'm Dylan Potter, Vice President Portfolio Manager here at Hound Rustling. We've received a number of questions about our thoughts on cryptocurrencies and ways in which to gain exposure to the ecosystem. The eye-popping returns and the incredible volatility capture headlines on a daily basis, so in today's StreetSmarts, we'll provide a brief overview of the space and offer some of our thoughts on it as well. Cryptocurrencies now represent a $3 trillion market, so it's becoming harder to ignore the space completely. First, it's important to note that this is a new frontier. What I mean by that is this space is evolving, changing, and growing on a daily basis. Some investors are attracted to the extreme price swings as a potential for profit. Some investors believed that if the lack of correlation with other asset classes continues, cryptocurrency could add diversification to a portfolio. For now, though, cryptocurrency prices historically have been highly volatile, and fluctuations could result in significant financial losses, regardless of whether you have direct or indirect exposure. We simply don't have a historical lens in which to frame cryptocurrencies. It's a new frontier. So with that, let's dive in. Cryptocurrency is a digital currency secured through one-way cryptography. It appears on a distributed network ledger called a blockchain that's transparent and shared among all users in a permanent and verifiable way that's nearly impossible to fake or hack into. So, if we dive a little deeper, the blockchain is simply a public record that has some very unique attributes that makes it incredibly secure and trustworthy. This public record exists on tens of thousands of computers around the world simultaneously. These are called nodes, and it's updated in real time. No one person or business controls these nodes, making Bitcoin and many cryptocurrencies decentralized. The original intent of cryptocurrencies was to allow online payments to be made directly from one party to another without the need for a central third-party intermediary like a bank. However, with the introduction of smart contracts, non-fungible tokens, stablecoins, and other innovations you may have read about, additional uses and capabilities are rapidly evolving. These transactions are just like every other financial transaction you're already familiar with, a transfer of value from one person to another. But instead of routing that transaction through a bank or other financial services provider, it's validated, recorded, and secured directly on the blockchain by all the nodes in the Bitcoin network. This process makes transactions on the Bitcoin blockchain secure and verifiable. Cryptocurrency's value stems from a combination of scarcity and the perception that it is a store of value, an anonymous means of payment, or a hedge against inflation. Cryptocurrency investors can buy or sell them directly in a spot market, or they can invest indirectly in a futures market, or by using investment products that provide cryptocurrency exposure. So how does one invest in cryptocurrencies, and what are our thoughts on the ecosystem? For investors interested in cryptocurrency, Charles Schwab and Fidelity have several choices for gaining exposure to the space, although spot trading of cryptocurrency is not currently available at those custodians. We'll talk about that though in a second. The first way to gain exposure is through cryptocurrency coin trusts. These products allow investors to trade shares in a trust holding large pools of cryptocurrency, although sometimes these can involve high volatility, hefty fees, and some other risks. They trade over the counter and they behave like closed-end funds. You may have seen some of these touted on the news, but some examples are the Grayscale Bitcoin Trust, whose ticker is GBTC, or the Grayscale Ethereum Trust, whose ticker is ETHE. Of note, these are not ETFs, but many of the players in this space are actively filing to get their products reflagged as ETFs so they may trade like any other ETF you're probably already used to. Next, some companies provide indirect exposure to cryptocurrency due to the company's relationship to digital assets. If owning the underlying asset is like panning for gold, imagine these companies as the ones supplying the picks and shovels. Here are just a few examples. Coinbase, whose ticker is COIN, PayPal, whose ticker is PYPL, MicroStrategy, whose ticker is MSTR, and Square, whose ticker is SQ. All these companies either hold digital currencies as assets or specialize in making markets and providing exchanges in which to trade them. Finally, you can open an account to trade the actual underlying currencies like Bitcoin or Ethereum. This can be done through a number of different companies like Coinbase or Gemini. Once you have an account, you can purchase the actual coins you are interested in. So, just to sum it up, you can own the assets outright by opening your own account at a place like Coinbase. You can gain indirect exposure by owning the companies that provide the picks and shovels for the ecosystem. Or number 3, you can gain exposure through a fund that invests its assets in cryptocurrencies. So, what's our perspective? We suggest that investors who are interested in cryptocurrencies approach them as speculative investments and consider their goals as well as the risks involved when owning crypto. For those who already have a diversified portfolio and a long-term investment plan, we see crypto as being used primarily for trading purposes outside of the traditional portfolio. It's like any other high-octane volatile investment. With the opportunity for outsized returns comes an extreme amount of risk. You should only consider investing in any riskier asset class, like crypto, once there's no other buckets to fund and you still have excess cash flow left over to invest. Thanks for tuning in to today's Street Smarts with Howland Rustling. We hope to see you next time.